Hello all. So today we are going to start our chapter number 10, which is on report writing. It carries 3 marks as per IBBI syllabus. Very easy to understand, and 3 marks are very easy to score. That is why this chapter has been taken before taking classes on accounting, statistics and economics, which are pending in the syllabus, and we're going to take up in upcoming sessions. So in today's session, we're going to talk about quality, structure and style of valuation report writing for various valuation purpose. Though this various valuation purpose we've already covered in a separate series. There are 4 videos. Link is given in description box below, and also about the content of the report. So this is the syllabus which carries 3 marks as per IBBI exam syllabus. So these are the 4 qualities of a valuation report. So valuation report should be written in a simple language, like an essay, easy to understand by a non-professional target reader. The report should have a convincing conclusion. So basically these are the following 4 qualities which a valuation report should have. Number 1, it should be orderly and organized. There should be continuity in the report. It should be properly arranged, and it should be definite and concise. So what is the meaning of orderly and organized? The report must follow an order which is definite, systematic and logical sequence as under information and data, facts, findings and last conclusion should be in order and properly organized. So continuity, to ensure continuity among 3 sections which we discussed in the last previous slide. So other information like schedules, statement, etc. should not be part of the main body of the report. Please note down this thing. Instead, these should be attached to the report as appendix or annexures. They should be given separate annexures to ensure continuity of the report. Third important point of report is should be properly arranged. So report should be arranged in such a manner that a client can easily refer to any particular part of the report without any difficulty. So heading and subheading should be given, and these should be self-explanatory for the readers so that they can refer any page and any section of the report easily. And fourth characteristic is definite and concise. The report should be brief and to the point. That is neither too long nor too short. The report should be such as to convey maximum meaning in minimum use of words. So Gagar mein Sagar. So this is a general structure of valuation report. So various parts of valuation report should be, first portion is instructions, then purpose of valuation should be defined, then executive summary should be there, collection of data and narration of facts, analysis of information and data, conclusion, and last is supporting material if any, like statements, tables, charts, graph, plans, maps, photographs, etc., which normally forms an annexure to the main report. So the report shall also include the definition of value, market value, assumptions and limitations, method of valuation and caveats. Let us discuss all these 3 points in detail. So definition means in last 60 years in a number of land acquisition cases, the Honorable Supreme Court of India has held that the market value must satisfy the definition of willing buyer and willing seller concept. So this market value definition we have already covered in our chapter number 8 part 1. Very long back we have already covered in session number 1. So please refer to that video which explains various type of valuations. Link is given in description box below. So as a general rule, if no definition of market value is given in a report, then it is presumed that standard definition satisfying willing buyer and willing seller. So if you are silent on if you're not giving the exact definition of market value, then court will assume market value definition of market value satisfying the concept of willing buyer and willing seller. In cases where the value estimated is different from the standard definition, it must be necessarily clearly defined in the report. In case you are giving any other valuation other than market value, so it should be explicitly defined in the report with the proper definition narration. Otherwise, court will assume it as market value. Next is assumption and limitations. Valuer should disclose the limitations faced by him, if any, while collecting and verifying the information and data, if any. Also, assumptions, if any, made to overcome the limitations must also be stated in the report explicitly. So if there is any limiting condition regarding use of the report, the same must be clearly mentioned in the report. Please highlight these assumptions and limitations while making a report. And then method of valuation is also important to be disclosed in the report. Based on facts and circumstances of each case, it is prerogative of the valuer to select any type of following three methods which he feels suitable. So as a valuer, I can select any of the methods, though there are broad guidelines, broad framework to guide a valuer. However, final decision and discretion of selecting a method depends on the valuer. So there are three methods: market approach, income approach, cost approach. All these three approaches we have already discussed in length, and separate playlist is there in description box given below. So please note that it is not necessary for a valuer to estimate property value using multiple approaches. It is a common misconception among valuers that they should do valuation of a property using multiple approaches. So it is not necessary basically. However, using alternative approach. So in any case, average valuation using multiple method should be strictly avoided, because in reality there cannot be an average valuation. So you have to, as a valuer, you have to decide upon normally on one method of valuation. You should give justification for why you have taken that approach to do the valuation. They should be clear about that thing in case in future somebody asks you. And once you've decided the approach, then you should calculate the value of the property using that approach only. So next fourth important point is caveats, which should be mentioned in the report. So caveats are essential parts of instrumentations setting limits to the extent of contract between the parties. So caveats exist especially in respect of confidentiality, physical information, and special circumstances. So let us discuss these four parameters one by one. So confidentiality, meaning of confidentiality here is, while writing a valuation report, the valuer must keep in mind about how the data and information in the report will be used, especially if the report is to be given to professional advisors and third parties. In order to limit the liabilities, valuer should state following clauses in the report. So these are the three clauses. Number one, the report is confidential to the client for specific purpose to which it relates. It may be disclosed to the other professional advisors assisting the client in respect of that purpose only, but the client shall not disclose the report to any other person. Second disclosure is, no responsibility can be accepted to any third party, including the professional advisors, in respect of whole or part of the report. And third important disclosure is, the valuer does not agree to any appearance or giving testimony, evidence in any court, any hearing or any other proceeding by reason of rendering this report unless prior arrangement have been made in that respect. So these three disclosure a valuer should made. Second point is physical. Detailed inspection of the asset is must. However, even after comprehensive site visit, latent defects, that is defects which cannot, what is the meaning latent defect? Please note down this point. 1 mark theory question may come out of this two words only, latent defect. So latent defects are nothing but defects which cannot be normally revealed even after thorough site visit. So these are called latent defects. So detailed inspection of the property to be valued is must. However, even after comprehensive site visit, there could be some latent defect which remain hidden from the eyes of the valuer. So a valuer can further protect it by stating that no investigation were possible for latent defects. This disclosure can also be made in the report by valuer to further protect himself or herself. So third point is information. So any information or data collected by the valuer from the client or from market should be quoted with the source of information in the report. The source of information should be reported in the report. So any information, if attributed to its source, creates no liability for a valuer unless it is so erroneous or misleading which a reasonably competent professional is expected to realize. In case the valuer gets to know that any asset is being used in contravention of any statutory requirement, etc., the same should be reported in the report. Please note on this point also. And third point is regarding information is that also the valuer interprets legal and statutory documents on the basis of his academic and professional education and evaluation. He is, however, not held responsible for final points of law and in cases involving finer points of law, a client may be clearly advised to seek legal opinion. So if you feel any legal nitty-gritty or any complex thing is there, you can give an opinion to the client that they should seek legal opinion or specific expert or professional opinion with respect to that point. And the fourth and last point is special circumstances. The caveats stipulated in the report establishes the limits. However, the same must be revealed to the client's needs and in practice as the respect will be of little or no benefit to the client. So next topic is report writing for various purpose of valuation. So valuation can be required for various purposes, and all these purposes can be broadly categorized into two major groups. Number one, fiscal purpose, and other one, non-fiscal purpose. So fiscal purpose include doing valuation for income tax purpose, capital gain, stamp duty, municipal taxes on land building collected by local bylaws. And non-fiscal purpose could be like, for example, sale purchase valuation of properties in case of dispute in court, probate and partition, etc. Award of compensation for compulsory acquisition of property for public purpose. This public purpose definition we will deep dive when we will go through the session on laws on real estate, which we are going to discuss in days to come. Valuation of tangible assets owned by Government of India, state government, PSU, local bodies to a certain return on investment or current value. Liquidation of asset for recovery for commissioner, high court, official liquidators. Rent fixation at the time of leasing, renewal of lease, property valuation for mortgage and auction by bank, etc. So let us go through in subsequent slides and try to understand each and every purpose with certain examples and important examples and case studies also. So first purpose of doing valuation under fiscal purpose category could be doing valuation for income tax purpose. So as per instructions of the client, if valuation is required for justification of amount spent on construction carried out, the valuer shall use quantity surveying method to calculate cost of construction on date of valuation. So it is important, cost of construction is being calculated on the date of valuation. Valuer can also do valuation by cost in the index method. So this method we will and try to understand with more detail in session number 4 of current playlist. If valuation is required for justification of investment made in acquiring rights in immovable property, the valuation shall be carried out as per definition of market value, satisfying willing buyer and willing seller concept. This concept we discussed in our first session, the concept of fair market value. So capital gain as on 1st April 2001 as per section 48 of Income Tax Act 1961. Long-term capital gain, it is also abbreviated as LTGC, is equal to full value of consideration or accruing minus index cost of acquisition minus index cost of improvement minus cost of transfer. So we'll further understand this formula in session number 3 of current playlist. Next purpose under physical purpose category could be doing valuation for stamp duty collected by state government. So in case of transfer of property, a stamp duty is required to be paid as per stamp manual published by the state. The valuer may be required to calculate circle rate value or government rate value of the property. Municipal taxes on land and building collected by local government. For calculation of property tax, most bodies follow carpet area concept. However, some local bodies follow circle rate valuation and rental valuation concepts methods, so which require estimation by valuer as per provision of the relevant act. Now these are the non-financial, non-fiscal purposes like sale, purchase of property, valuation dispute in court, probate and partition, etc. So in such cases, the valuations submitted by the valuer should be based on definition of market value, satisfying concepts of willing buyer and willing seller. Then award of compensation for compulsory acquisition of property for public purpose. If valuation is being done for this purpose under Land Acquisition Act, then under section 26 of Right to Fair Compensation and Transparency in LARR Act 2013, the basis is provided under Act and the same is non-market basis. So here in this case, if we are doing valuation for this purpose, then basis of providing the valuation as per the Act is the non-market. It is not market value. It is a non-market base of the non-market value of the property as per the Act, provision of the Act. We will try to understand this Land Acquisition Act in our upcoming session on real estate laws. Valuation of tangible assets owned by Government of India, State Government, PSU, local bodies to a certain return on investment or current value of the asset. If valuation is being done for any of these purposes, then the basis shall be market value, satisfying concept of willing buyer and willing seller. Please note down all these bases because 1 mark theory question can come out of any of these slides. So in case of liquidation of asset for recovery for commissioner, high court, official liquidators, the basis of valuation depend on instructions received from the client as under. If client has informed that the seller is not willing to sell, purchaser purchases with the knowledge that the seller is compelled to sell, and marketing time is less. So these three conditions should get fulfilled. First, client has informed that the seller is not willing to sell. Second, purchaser purchases the property with the knowledge that seller is compelled to sell. And third, marketing time is less. If these three conditions fulfill, then basis of doing valuation by you for any of these three purposes should be based on shall be other than market value. If client's instruction are to carry out valuation as per definition of market value, satisfying concept of willing buyer and willing seller, then the basis of valuation shall be market value. So these two definitions and these two scenarios please remember, if in case 1 mark theory question can come. So if client is telling us that we have to do valuation satisfying concept of willing buyer, willing seller, then it should be market value, and in all other cases it should be other than market value. Next type of valuation or purpose of valuation could be rent fixation at the time of leasing and renewal of lease. In case of lessee or occupant who are not protected under Rent Control Act, valuer services may be required to fix rent as under. So in case of Rent Control Act, rent is being fixed by court in the form of standard rent. Further details we will discuss in upcoming series on real estate laws. The rent of building is fixed upon the basis of certain percentage of annual interest as the capital cost and all possible expenditures as outgoings. The net return is worked out based on capital cost and year purchase. If capital cost is not known, this may be worked out by any of the method of valuation. Three methods we have understood in previous session. So the owner expects about 2% higher return than the prevalent interest to cover up the risk of his investment. So whatever investment return the owner is getting from the market, say on government securities, so the owner may expect 2% higher return as compared to government securities or gilt. So to this net return, all possible expenditure on outgoing are added to the gross annual return rent. So first of all, we calculate net rent and then plus outgoing, that will give us the gross rent which owner should charge to the occupant or lessee. In case of property valuation for mortgage and auction of banks, so as per section 5 of Banking Regulation Act 1949, the valuer need to provide valuation basis market value concept only unless any other basis of valuation like forced sales value is demanded by FI or bank. So please note down, as per BR Act, this is the provision. So this should be the basis. So if bank has not given us any specific instruction about purpose of doing valuation and what type of valuation the bank is required, we are supposed to, or we are expected to submit market value of the property, assuming willing buyer and willing seller. However, if the bank or FI has specifically asked us to submit some other type of valuation like forced sales value, distress sale value, orderly liquidation value, all these valuation we have discussed in first session, already uploaded in the website, YouTube channel. So then we have to give that specific valuation. In case of auction reserve, the basis of valuation shall always be market value concept only. So please note down, 1 mark theory question can come and examiner may ask that you have to give valuation of a property for auction of the bank. Then what should be the basis of your valuation? Market value or forced sale value or as per demand of the bank? So it should be market value only in case of auction reserve. Insurance of immovable and movable property. If this is the purpose of doing valuation, in that case the basis of valuation depend on type of policy, that is reinstatement cost new, indemnity basis and such other basis as identified in a fire insurance contract or policy. IFRS, full form of IFRS is International Financial Reporting Standards. The basis of valuation shall be instructed by the auditors or financial advisors or CFO of the company, based on which as a valuer is supposed to submit the valuation. Now let us deep dive these methods further and from examination purpose. So valuation of property is for bank finance and loan purpose. From banker's perspective, the value of security or property must be sufficient to cover the principal amount with interest at all times during the currency of bank loan. This periodic review of security is required from the angle of market value, whether it is a fresh valuation or repeat valuation, along with market value of the property. If the valuer provides following additional risk inputs, it would be helpful to the banker. So in addition to the market value of the property, so following these two parameters, if as a valuer we will provide, then banker will be happy and he will appreciate your efforts. So first parameter which as a valuer I should report in my valuation, market risk rating of the property. So it could be properties can be classified into 4 type of segments: low, low to medium, medium to high and high. And second is valuer's opinion on recent market direction. Then we can also put in some information on this piece. Then valuer opinion on market volatility, valuer opinion on local economy impact. So in case of valuation of properties for auction reserve purpose, as per SURFACI Act 2002, the 34 AB Wealth Tax Act registered valuer need to provide value of the property. So this is important point, please remember it. 1 mark theory question can come. The banks normally seek market value and distress value of the property from the valuer. Reserve price is fixed at distress value of the property. This is also important term from examination purpose, that reserve price is always fixed by the bank at distress value, which we give in the valuation report. Next type of valuation is valuation for mortgage. So as per section 5 of Banking Regulation Act 1949, market value of the property not at any time should be less than the loan or advance amount against the security. So this is important terminology, that during the currency of bank finance, value of security, value of property should not be less than the exposure on the customer, including all expenses, including all accrued interest and other charges. Generally speaking, the basis of mortgage valuation should be fair market value of the property at the time of valuation, subject to following consideration. The valuer should exclude from the valuation any part of mortgager's interest which cannot be transferred to the mortgagee. For example, goodwill associated with business premises, so it cannot be part of my property valuation. Also, things on land like sand, gravel, timber, etc., which can be easily sold or removed by the mortgagor, should not be considered as a part of valuation of property. Possible future increase in valuation of a speculative nature should be excluded or disregarded. So any expected rise in property valuation in future should not be taken into consideration. However, possibility of any decrease in valuation of future, if any, should be considered carefully. So if as a valuer I feel that prices are inflated or prices are likely to go down because of certain factor which I foresee, so accordingly I should consider those factors, and I should give my valuation carefully. Allowance should be made for any capital expenditure which may be necessary in future. Then this we have to consider by doing valuation of such properties for mortgage purpose. If building is in bad repair or bad condition, maintenance, the cost of necessary work should be deducted. Alternatively, the structure may be valued as in good repair, subject to an express undertaking given by the mortgagor to put the building in repair forthwith. Valuer should give a careful ear to the information about the price paid by the mortgagor to purchase the property or as to cost of construction of the building. So we should interview the mortgagor, and directly and indirectly we try to extract some information about cost of purchase and how much amount he spent. That we should try to extract from the mortgagor itself. The valuer should compare the estimated net income from the property with annual amount of annual interest on the proposed loan, and accordingly should be decided how much amount can be given against the mortgage. Next is how much loan amount can be sanctioned against the property. 1 mark numerical question can come, or theory can also come out of this slide. The normal advance is 2/3 of the property value. However, if there is doubt as to what the property would realize if brought to a forced sale at any time, or there is a possibility of the market value depreciating in the future, a smaller loan amount, possibly 3/5 or maybe half of the property, may be recommended. Thereafter, the valuer need to correlate between the net income and interest on any suggested advance to recalculate recommended amount. So this is an example to understand the concept of recommending the amount as a valuer. So value of the following properties for mortgage purpose, stating the advance to be recommended in each case and mention any condition which should be imposed. Interest on mortgage of 6%. So a freehold shop in a first class position let to multiple tenants on a 21 years full repairing and insuring lease granted 16 years ago at the rent of 1 lakh rupees per annum, annual rent of 1 lakh rupees. The present rental value of the same property on same terms is 5 lakh rupees per annum. Year purchase 5 year for 5.5, considering capitalization rate of 5.5% is given as 4.27, and YP year purchase perpetuity considering capitalization rate of 6.5% is equal to 11.23. So this is the data given in the question. As I always say, always try to write first data given in the question for simple understanding. So in this case, rent as per ongoing lease deed is given in the question, which is equal to 1 lakh rupees per annum. So since the lease was executed 16 years back, so current market lease rent of the property has been increased to 5 lakh rupees per annum. This is the notional rent, current rent, and this is the actual rent, 1 lakh rupees. Total lease period is 21 years. Expired lease period is 16 years. That means remaining lease period is equal to total lease period minus expired lease period, which is equal to 21 years minus 16 years is equal to 5 years. This is a 5 years remaining lease period. The property is going to generate income of 1 lakh rupees per annum for next 5 years. And after that, the property will generate 5 lakh rupees per annum after expiry of the remaining lease period of the current lease. Year purchase 5 year, 5.5% capitalization rate is 4.27 given in the question, and year purchase perpetuity capitalization rate of 6.5% is given in the question as equal to 11.23. So as we know how to calculate value of a property using income approach, Thus the property value in this case will be equal to present value of rent for remaining 5 years, which is 1 lakh rupees per annum, plus present value of reversionary rental value of the property which we are going to get after expiry of 5 years, that is 5 lakh rupees per annum. So lease rent, annual lease rent multiplied by year purchase 5 years 5.5%, which is given in the question. We multiply it figure 1 lakh into 4.27. So 4.27 is the amount or present value of the rent which we are going to get from the property for next remaining 5 years of unexpired lease period, and 5 lakh rupees thereafter we'll start getting annual basis. And if we multiply it with year purchase perpetual 6.5% given in the question, so that means it is equal to 5 lakh into 11.23. So total value of the property is 60.42, say 60 lakh rupees. So this is the value of the property considering income approach or based on rental method. Now maximum loan recommended should be lower of the two, as discussed in the last slide. 2/3 of the property value, which is equal to 2/3 of 60 lakh rupees, is 40 lakh rupees. So this is the maximum loan which can be granted against the property considering LTV or basis mortgage of the property. Now next parameter is that since the annual interest rate on the loan is 6%, so considering 6% of interest, annual interest on 40 lakh rupees, the simple interest will be approximated to equal to 2.4 lakhs, which is less than the annual rent from the building. So here we are trying to understand how much rent the property is generating. So we have to understand the capacity of the property. Thus considering annual rent of 1 lakh rupees, maximum loan recommended is 16.17 lakh, that is equal to 40 lakhs multiplied by 1 lakh divided by 2.4 lakh. So this 40 lakh will be required for this 40 lakh rupees of loan. The mortgager will be required to pay 2.4 lakh rupees of interest annually. However, the property is earning only 1 lakh rupees. So the mortgager will not be able to serve interest of entire 40 lakh rupees out of rent of the property at least for next 5 years, right? So to ensure that the income to be generated by the company, by the property, should be able to meet interest expense of the loan, so we cannot sanction more than 16.16 lakh on this property considering the second parameter. Higher loan amount. The bank may advance higher amount of advance in excess of 2/3 of value of dwelling unit if the period of payment by borrower include both interest and proportion of principal, like an EMI. If the loan is proposed to be paid in EMI, that is why some banks give LTV up to 90%, even if in fact RBI also allows that LTV up to 90% in case of loan amount is up to 30 lakh rupees. The whole mortgage debt being repaid within a fixed term of year. So if period of repayment of the loan is fixed, 10 years, 20 years, 30 years, so higher loan amount can be sanctioned. Second or subsequent mortgages, if there is already a loan is ongoing on the property and mortgagor approaches to the lender for giving second or subsequent loan on the same property in the form of additional charge. In case the property is already mortgaged with the bank and the customer wants a second loan on it, the valuer should be careful to advise the second loan amount. However, the amount of second loan combined with first loan should not exceed 2/3 of the property value. For example, a property is worth rupees 90,000 rupees and rupees 50,000 has already been advanced on first mortgage. In order to keep total advance within 2/3, only rupees 10,000 can be advanced in second mortgage. Advance on multiple properties. While preparing a valuation report of multiple properties for the purpose of an advance by a mortgagee, the valuer should disclose value of each property and recommended advance against each of these properties. Valuation of building for building insurance purpose. Since property insurance policies against damage of fire and other accidental causes are based on the principle of indemnity. What is this principle of indemnity? We discussed this principle in our previous session on principle of insurance. There is a full-fledged playlist on it, but just to reiterate for convenience of all aspirants, principle of indemnity is compensation will be paid on proof of loss, but only to the extent of loss actually suffered. So first of all, proof of loss has to be given. Whatever coverage I have taken under the policy, my claim payout cannot be more than that, and my claim cannot be more than the actual loss suffered. So it is required to do indemnity valuation assessment. Indemnity value assessment. They are following two methods of calculating the indemnity value assessment: market value, depreciated reinstatement value method. It is also called DRV method, or reinstatement insurance value method. In short form, it is called RIV method. Market value or DRV method or depreciation replacement value method states that indemnity value will be equal to estimated cost of reinstatement of similar property as on date of proposal, RCM, at insured site. It is important, on the site of damage or on the site of insurance, plus suitable escalation for the policy period minus depreciation for age. If there is a reinstatement clause in the property, in the policy, or the mortgagor or the customer or the owner has taken reinstatement insurance policy of the property, then we have to use reinstatement insurance value method. So as per this method, indemnity value is equal to estimated cost of reinstatement, material plus labor, of similar property as on date of proposal, again at insured site, plus suitable escalation for policy period, plus suitable escalation for reinstatement period, which may extend beyond the policy period. Thus, this policy will pay in the event of loss damage without any deduction for depreciation. So in case of reinstatement policy, deduction for depreciation are not being done. Let us try to understand this with the help of an example. Say a building is having RIV, reinstatement insurance value, of rupees 8 lakh and depreciated value or market value of 650 lakh rupees as on date of policy. Its insurance premium is say 65 paisa per rupees 1000. Calculate insurance premium for RIV, reinstatement insurance value policy, and market value methods. Claim payout paid in both cases, RIV and market value methods. If the building gets totally damaged and actual cost of reinstatement of building as on date of damage is 900 lakh rupees. Claim payout, claim amount paid in case of partial damage. So here there is a full damage, here there is a partial damage, and cost of repair is 1 crore rupees, 100 lakh rupees, assuming actual cost of reinstatement of building is 900 lakh rupees as on date of damage. Data given in the question: indemnity value RIV has been given 800 lakh rupees, indemnity value market value method has been given as 560 lakh rupees, insurance premium is given as 50 paisa per 1000 rupees. So that means multiply by 100, that means 65 rupees per lakh. Since all values have been given in lakh, so we have converted this insurance premium into lakh per lakh instead of per 1000. So now we have to calculate the insurance premium, claim amount in case of full damage, and claim amount in case of partial damage. Insurance premium will be equal to indemnity value is given in the question and premium per lakh is given in the question. Thus, it is equal to 800 lakh rupees RIV indemnity value plus 65 rupees per lakh. So 52,000 rupees will be the insurance premium for the insurance of the property considering RIV method. And insurance premium considering market value method will be equal to indemnity value for market value as per market value method multiplied by premium per lakh, that is 560 rupees per 560 lakh multiplied by 65 rupees per lakh, that is equal to 36,400. So if the owner of the property wants to take a reinstatement value policy, then the insured has to pay extra premium of 15,600. So this is the extra cost, extra burden on the owner of the property, insured, in the form of extra premium. So let us try to understand what are the benefits he will get out of payment by paying this extra premium. So claim payout in case of full damage and RCN of 900 rupees. So here the insured will get, in case of RIV policy, here the insured will get rupees 800 lakh of claim payout from the insurer, insurance company. Thus insured will have to bear loss of rupees 100 lakh from his own pocket. Since there is no depreciation clause and the policy is issued on reinstatement clause basis, there will not be a deduction for depreciation. So entire amount of 8 lakh rupees covered under the policy for which the insured had paid the premium will be received by the insured and will be paid by the company. So if The insured has taken market value method policy or depreciated value policy. Then sum insured will be was 560 lakh rupees after deduction of depreciation. So thus that is the maximum amount he will get. So in that case, in case of loss of full property, the insured will get maximum 560 lakh rupees equal to sum insured in case of full damage, and remaining 340 lakh rupees of extra amount he has to pay from his own pocket. That means just by paying 15,000 rupees, 600 rupees, here the insured has got more amount of claim. That is a benefit. Let us understand the benefit in case of partial loss as well. So claim payout in case of partial loss of 100 rupees, 100 lakh rupees is equal to, so claim payout formula we have already understood in our previous playlist on insurance, principle of insurance. Just to reiterate, claim amount is equal to sum insured, claim payout is equal to claim amount multiplied by sum insured divided by current value of the asset or RCN. So all these figures have been given in the question. 100 lakh rupees is the cost of repairing the stuff, repairing the property, given in the question, multiplied by sum insured. In case of RIB policy, sum insured is 800 lakh rupees for which premium has been paid, and RCN has been given in the question is 900 lakh rupees. So here 100 multiplied by 800 multiplied by 900, it is equal to 88.80 lakh will be received by the insured from the insurance company in case of this damage of 100 lakh rupees. However, in case of market value policy, the claim payout will reduce to this, because here the sum insured has been reduced from 800 lakh to 560. So accordingly, payout coefficient will get reduced, and accordingly he will get 62.20 lakh. So that clearly indicates that RIB policy gives better protection to the insured. Now next is valuation of properties for sale purchase purpose. Sometimes a buyer or a seller of a property may seek a valuation report from the valuer. The valuer should prepare the report assuming that the client has no idea about the property. Thus the valuer, along with fair market value of the property, should also provide all other information like description of the property, structural quality of the property, specifications, accommodation, state of repair, its potentialities, defects, etc. Valuation of properties for valuation of disputes in court. In case of dispute arising between the client and the valuer, court seeks opinion of another government registered valuer. This is an important slide. 1 mark 3 question can come out of it. So if government registered valuer gives value which is in range of 10% of the original value, the court will rule in favor of first valuer. So if I have submitted a valuation in the court and it has been disputed by the other party, court may appoint another valuer, and if the new valuer gives his valuation within the range of 10% plus minus 10% of my valuation, then court will say that my valuation is okay, previous valuation was okay, there is no dispute in that. However, if government registered valuer gives value beyond 10% of the original value, then court shall seek opinion of another valuer, that is third valuer. Then court will appoint another third valuer and shall adopt final market value basis two valuations with minimum difference. The court will decide upon any value ranging between those two values as mutually agreed between the two parties. Valuation of properties for probate purpose. Probate valuations are required to determine the amount of duty payable to government while taking the probate of a will on death. So what is this probate, that we will discuss in our upcoming series on laws on real estate valuation and general laws. Just for simple understanding, in case of death of a person and who has written a will, so a probate or a written document or a certified copy of the will kind of is required to be done from the court. It is a confirmation of the title transfer. That will deep dive further in subsequent sessions. The duty is charged on the whole of the property passing or deemed to pass in case of death and varies from state to state as per State Stamp Act. The probate valuation takes into account the genuineness of the will, terms and conditions specified in the will, members involved in the will, and details of the property. So these are the important few points about basis of doing probate valuations, which each valuer should understand, and the theory question, 1 mark theory can come out of any of these bases. So the capital value or principal value, as it is called, capital value of real property and leasehold for estate duty purpose is the price which the property would fetch if sold in open market as on date of death. This is the definition of capital value, and it is also called principal value in case of probate valuation. 1 mark theory question can come out of it. In dealing with undivided share in a property, the customary deduction of 10% or possibly more in some cases is usually allowed. So if a property is having multiple divided share, 2-3 sons or sisters are there, mother share is also there. So if you are doing undivided share of the property, then 10% is normally deducted. However, as a valuer, if we perceive with suitable justification, we may allow high deductions as well. In making the valuations, all ordinary outgoings are taken into account. So whatever ordinary outgoings are expected, so all those have to be taken into consideration. However, no allowance may be made for possible expenses for sale, because actual sale of the property is not happening. So whatever expenses like brokerage, the expenses which a owner of a property is supposed to pay to actually sell the property, these expenses of sale are not expected to be deducted while arriving at the valuation for the probate purpose. Valuation must be done assuming that the property is being placed in open market in the most advantageous way. This is another aspect, another basis which as a valuer we should understand. For example, a large estate comprising a mansion and a large agricultural land would probably fetch better price if put up for sale in separate lots. No allowance may be made in the valuation for the fact that such a course, if carried out in practice, might result in flooded market and reduced prices. So if we are having multiple properties under a single will, and if we sell all the properties in the market, so it may flood the market with number of properties and may temporarily reduce the price. So that factor we are not considered as a valuer. We're not supposed to consider, and we're not supposed to give any allowance. We're not supposed to reduce property value based on this factor. However, it may happen in practical scenario. In exceptional cases, if value of the property is depreciated by the death of the deceased, this fact may be taken in account. So if because of the deceased person, death of the person who was deceased, the property value is decreased, so with suitable justification that can be deducted from the property value while doing probate valuation. So please note that these two notes: in case shortly after death, immediately after death, property is sold at a higher figure than that of the probate value. So valuer has given a probate value of say 100 rupees, and after that the property is being sold at 150 rupees. Then government may claim payment of additional duty unless it can be proved that the higher price was due to a rise in value subsequent to the death. So if probate valuation has been given 100 rupees and say within next 2-3 months or 6 months the property is being sold at say 200 rupees. So government can tell the owner of the property that you have to pay extra stamp duty to us. The property was undervalued. However, if that increase is because of any factor which has happened after the death of the person, then government, you can justify your request the government not to claim additional duty. In case likewise vice versa also, in case shortly after death, if property is sold at a lower price than probate value, refund of stamp duty may be claimed unless the fall is after death. So likewise, if probate value has been given as 100 rupees and stamp duty for 100 rupees has been paid, but say in near future the property is being sold at 50 rupees, then you can approach to government and you can seek refund of the stamp duty unless that fall is not because of the factor which surfaced after death of the person. Next is valuation of properties for partition purpose. Here market value of the property is being calculated and then divided among the parties as per shares they are entitled to in law as per applicable to them. Valuation of property for stamp duty purpose. It is required for calculation of stamp duty payable on data for execution of transfer instrument. It is worth noting that the stamp duty is charged on actual transaction amount, which should not be less than circle rate or guideline rate of the property. The valuation of property for lease mortgage purpose. Here the property value is equal to net annual rent or NOI for the property divided by capitalization rate. Thus, it is equal to the net annual rent can be derived directly from the available market data, thus giving realistic and objective opportunities for comparison. The capitalization rate must be fixed separately in each individual case in accordance with the local market situation, taking into account property, location, demand criteria, and the potential for alternative uses of the property. Valuation of properties for fixing reserve price for auction. Then reserve price for auction of fixed price as distress value, which is normally 80 to 90% of the market value. For example, the client may wish to sell the property at a short notice because the local authority has served notice of repair on him, and he doesn't want to trouble on complying with them. He may go for auction of the property and may tend to sell the property in distress value. Valuation of share in a property. Land is often held in shares by several persons, whether by way of joint ownership or joint undivided shares. A share in property is normally less attractive to the investor than absolute ownership due to the fact that the control of the property is divided. So every buyer prefer to buy absolute ownership as compared to undivided share. So value of share is equal to market value of full property multiplied by share to be valued. If I have say 25% share in a property and total property value is 100 rupees. So this is 100 rupees is total property value. My share is 25%, so 25 rupees is my share in the market value. Then as a valuer, we have to make certain deductions for disadvantages in case of undivided control. Normally it is recommended for 10%. However, higher reductions may be allowed basis suitable justification. So third and last topic of this chapter is contents of valuation reports. The content of the report and information to be reported depends upon the nature of the assignment. However, minimum requirement, this is not exhaustive, of a valuation report is as under. So this information can be broadly classified into two major parts. Number one is executive summary and part two is annexes. Please note down these two parts. So first executive summary. So it will give the gist of the exercise in about less than 10 to 15 pages so that it can serve purpose of management. The contents of executive summary are as under: identity of valuer. The letterhead of valuer must show qualification of the valuer to perform the assignment. Second, date of report, the date on which report is submitted. Instructions, detail of property to be valued with the location provided by the client. Date of valuation of property. Normally it is prior to date of valuation, so other than IBC valuation. So purpose of valuation is stated by client. Checklist submitted and information submitted. Definitions of market value for any other valuation which we are giving in the report. Basis of valuation as per terms of reference. So how the exercise is conducted, the procedure adopted by the valuer, market approach, income approach, then method approach, method cost, income, market approach. Then general remarks, if any, should be highlighted. Assumptions and limitations and conditions, if any, used by valuer should be disclosed in the report. And finally, the summary of the valuation. Summary of value is estimated. In the part 2, which is annexures, will include details of property valued along with supporting document used in estimating the valuation. So these are the steps which are to be used for doing valuation of property. So these are basically 4 steps. The first step is terms of reference. Second step is basic issue of assignment. Third step is data collection, selection, analysis, and fourth step is application of valuation approach. So this 1 mark theory question may also come out of this slide. So step 1 includes source of instruction, purpose of valuation, and date of valuation. Step 2 includes which is basic issue and assignment, identification of the asset, then identification of rights, title, interest, then inspection of land, site visit, survey of the building, data as on which valuation is to be made to be calculated by the valuer, and then applicable basis of valuation is to be decided by the valuer. Then data collection, selection, analysis could be done from government sources, local bodies, development authorities, neighborhood sources, market sources, any literature sources, client sources, and all these sources should be disclosed in the report. And fourth and last step is application of valuation approach. So we know that there are three approaches: income capitalization approach, which is normally being used for investment asset; sales comparison approach, which is normally used for marketable assets; and cost approach, which is normally used for specialized asset. So as a valuer, we have to decide upon it. So that's all for today's session. Thank you all for watching this session. So before I'm going to tell you what we are going to have in next session based on poll conducted for the subscriber. So I would request you to please subscribe to the channel and click on bell icon if you have not done till now. So in next session we are going to discuss about bookkeeping and accountancy because majority of viewers are asking for this session on urgent basis. So we'll discuss about meaning. We'll have a quick walkthrough of these things. We will not deep dive into this thing, but from IBBI exam perspective, we'll try to cover as much as possible so that as an engineer we can understand basics, and we should target to score, if not 3, at least 1 or 2 marks out of 3. So at least 2 marks you can score after going through that next session. So, and you could also score 3 marks as well depending on complexity of the question, but normally you will be able to score easily 2 marks out of 3 into accounting session. So we'll try to decode all these bookkeeping and accounting in a very simple and plain manner, considering that we are engineers and we are from non-accounting background. Thank you all.